Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MANPOWERGROUP INC quarterly report. Manpower Group Inc. offers a diverse range of workforce solutions and services under its Talent Solutions, Manpower, and Experis brands. These include recruitment services for professionals and administrative, industrial, and IT positions assessment, upskilling, reskilling, career management, and training development services, outsourcing services for human resources functions, such as large-scale recruiting and workforce-intensive initiatives, contingent staffing and permanent recruitment services, information technology, professional resourcing, and project services, recruitment process outsourcing, and management solutions through TAPFIN, a managed service provider solution. The significant drop in Manpower Group Inc.'s stock price over the past year can be attributed to a combination of disappointing financial results, substantial impairment charges, a challenging global labor market, and analyst downgrades. Disappointing earnings performance has been a major contributor, with the company consistently reporting declining revenues and lower profitability. Restructuring costs and goodwill impairment charges have also weighed heavily on earnings, particularly in Q2 2025, when a notable $89 million goodwill impairment charge was recorded. The challenging global labor market, characterized by cautious employers, softer demand in temporary labor, and declining permanent recruitment activity, has further limited growth prospects and put pressure on margins. Currency headwinds and hyperinflation have also contributed to the financial strain. Analyst downgrades and price target reductions from prominent investment firms such as UBS, Goldman Sachs, Barclays, and Truist Financial have reflected a more cautious outlook on the company's future performance, exacerbating the stock price decline. The primary drivers of revenue growth or decline can be identified from various segments and regions within a company's financial summary. Revenue growth is primarily driven by the Americas segment, which saw an increase of 10.5% due to strong performances in the United States and other Americas. The Southern Europe segment also contributed significantly to revenue growth, with Italy and other Southern Europe experiencing increases of 8% and 15%, respectively. In contrast, revenue decline was mainly attributed to the APME segment, which saw a decrease of 12%. France was another significant contributor to revenue decline, with a drop of 12% due to the exclusion of Morocco business. The Northern Europe segment also experienced a decline of 7.8%. The drivers of revenue growth and decline can be summarized as follows. Revenue growth: Americas segment 10.5%, Southern Europe segment 12.3%, revenue decline. APME segment 12%, France 12%. These key drivers highlight the importance of regional performance in determining a company's overall revenue growth or decline. Net income and profit margins experienced significant declines between 2024 and 2025. Net income plummeted by 135.5%, minus 138.6% in constant currency, from $122.6 million to minus $43.5 million, primarily due to goodwill impairments of $33.40, United Kingdom, and $24.70, Switzerland. Profit margins also decreased, with gross profit margin falling from 17.2% to 16.6%, operating profit margin decreasing from 15.5% to 8.1%, and OUP margin dropping from 3.4% to 3.1%. The decline in profitability was attributed to increased expenses and decreased activity in higher-margin services in France, Italy, and other Southern Europe, as well as the cyclical nature of the business, which is sensitive to macroeconomic conditions and client demand dependent on labor market strength and secular trends toward workforce flexibility. The company's financial performance indicates a negative trend in operating cash flow. Despite some contradictory information suggesting otherwise, the majority of data points confirm that the company is generating negative operating cash flow, with a net cash outflow of $283 million for the 9 months ended September 30, 2025. This suggests that the company's operations are consuming more cash than they are generating, which could be a concern for investors and stakeholders. The financial performance of the company varied across different regions in the recent period. The Southern Europe region stood out with a revenue of $2,205.50 and an operating profit, OUP, of $65.60. In contrast, the Americas region showed positive growth, with a 2% increase in the United States and a 7.9% rise in other Americas. The Asia-Pacific, Middle East, and Europe (APME) segment also performed well, generating revenue of $520.50 and an OUP of $26.80. However, the Northern Europe region struggled, with a negative OUP of $14.90 and a decline of 7.6% in growth. Management's outlook on company strategy. Management is cautious about the company's outlook due to deteriorating macroeconomic conditions, particularly in Europe. They have reduced revenue growth and operating profit margin assumptions for European regions. However, they are focused on expanding presence in key markets, including Southern Europe, where revenue grew by 24%. To manage currency risks, the company has entered into new cross-currency swaps. Management is prioritizing cost control, with operating expenses increasing by only 12% compared to last year. They anticipate an increase in working capital needs due to increased demand for their services. The company's business is cyclical and sensitive to macroeconomic conditions, but management believes that available cash and credit facilities are sufficient to cover cash needs for the foreseeable future. Overall, management is taking a cautious approach to managing the company's outlook, focusing on cost control, revenue growth, and currency risk management in uncertain economic times. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In the past 2 years, it has paid dividends in 2024 and 2025, indicating a consistent effort to distribute profits to investors. Additionally, the company has also engaged in significant share repurchases in both years, buying back millions of shares at substantial costs. This dual approach suggests that management is focused on rewarding shareholders while also reducing the outstanding share count. That concludes the financial summary for MANPOWERGROUP INC. Feel free to comment below, and I will be happy to answer them when possible.